Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Today, we build a machine. This is the tactical how-to. Who do you actually call to get this done? What does it really cost? What properties are a grand slam for this strategy, and which ones are a waste of time? And most importantly, I'm going to reveal the one fatal trap I warned you about, the depreciation recapture trap that can cost amateur investors everything. And I'll show you the pro-level escape hatch. Let's get into it. The single biggest mistake I see investors make is thinking this is just a simple tax form. They go to their CPA and say, hey, can you do one of those cost segregation things for me? Now, this is a critical and potentially very costly error. Your CPA is a tax expert. They are not an engineer. A real defensible IRS-proof cost segregation study is an engineering-based report. This is non-negotiable. You must hire a specialized firm with qualified engineers who will conduct a detailed study of the property. They will physically or virtually walk the site, analyze blueprints, and break down the entire building into its core components: the electrical, the plumbing, the flooring, the HVAC, the site improvements. Your CPA's job is to take that finished engineering report and use it to correctly file your taxes. They are two different critical parts of your team. Do not try to get your tax preparer to estimate it. That is a red flag for an audit. So what does this level of professional work cost? You'll see cheap online studies advertised for $1,000. Be very, very careful. A low-quality non-engineering study is a risk I'm not willing to take, and you shouldn't be either. Here's the data. For a high-quality engineering-based study on a typical property in the $1 million to $5 million range, you should expect to pay between $5,000 and $15,000. Now, you hear that number and you flinch, but this isn't a cost, it's an investment. Let's go back to our math from last week. On our $2 million property, we found $500,000 in year one bonus depreciation deductions. If you're in a 35% combined tax bracket, that's $175,000 in real cash savings. Would you pay $7,000 to get $175,000 back this year? You do that deal all day, every day. The ROI is massive. This is a core part of the manage phase of your prime framework, optimizing your asset for maximum cash flow. Cost segregation is a sniper rifle, not a shotgun. It does not make sense for every property. The waste of time is your $200,000 single-family rental. The purchase price is simply too low. The cost of a $5,000 study will eat up too much of the potential savings. Don't do it. The perfect candidate is where the pros live. This strategy is designed for larger assets. You're looking for 1. Properties acquired, built, or renovated after 1986, and especially those you placed in service this year after January 19th, 2025, to get that new 100% bonus depreciation. 2. Properties with a cost basis over $1 million. The bigger the purchase price, the more components there are to reclassify, and the bigger your year one deduction. 3. Properties with heavy personal property components. This is the secret. Apartment buildings, this is the classic. They are full of 5-year assets, cabinets, appliances, carpets, vinyl flooring, and fixtures in every single unit. Self-storage, like we covered in episode 59. These are gold mines for 15-year property. Asphalt paving, fencing, landscaping, and security systems. Data centers. As we discussed in episode 62, these are almost all personal property. The specialized electrical, cooling systems, and server racks are the definition of 5- and 7-year assets. Hotels, medical offices, and restaurants. These are packed with 5-year property, carpeting, decorative lighting, furniture, and specialized equipment. Now, here's the key. You should be thinking about cost segregation before you even buy the property. This is a core part of the research phase of your prime framework. Factoring in a 25% reclassification and 100% bonus depreciation can completely change your year one cash-on-cash return calculation. It can turn a meh deal into a home run. All right, listen closely. This is the most important segment of the episode. This is the part I promised you. This is the trap that snares amateurs and costs them everything. In investing, there is no free lunch. There is only a strategically deferred one. When you use cost segregation and 100% bonus depreciation, you are taking decades of tax deductions and pulling them all into year one. The IRS is letting you do this, but they don't forget. When you eventually sell the property, they will recapture those deductions. Here's the trap. When the IRS recaptures that $500,000 in bonus depreciation you took, they don't tax it at the low 15% or 20% long-term capital gains rate. They tax it at your ordinary income tax rate. Let that sink in. That could be 24%, 32%, or even 37%. This is the amateur's nightmare. Let's play it out. You buy the building, you take that $500,000 deduction, saving you $175,000 in taxes, assuming your 35% bracket. You feel like a genius. 5 years later, you sell the property for a big profit. Your CPA sits down to do your taxes and says, well, we have to recapture that $500,000 in depreciation. Your ordinary income bracket is 37%. You owe $185,000 in recapture tax. You just gave all your tax savings back and then some. You fell for the trap. So what's the solution? How do the pros really win? The pro-level investor knows the recapture trap is coming, and they know exactly how to avoid it. They never just sell. They execute the final critical step of the triple threat strategy we talked about last week. They use a 1031 exchange. As we covered in our deep dive in episodes 101 and 102, a 1031 exchange allows you to sell an investment property and defer all of your capital gains taxes as long as you roll those proceeds into a new like-kind property. But here is the $1 million secret. The 1031 exchange also defers the depreciation recapture. All of it. That $185,000 tax bill, it doesn't get paid, it gets kicked down the road, rolled right into the basis of the new property. 1. You buy an asset. 2. You cost segregate it to generate a massive paper loss. 3. You use that loss to shelter your income and buy more properties. When you're ready to move up, you 1031 exchange into your next bigger deal, deferring both the capital gain and the recapture tax. And on that new bigger property, you do a cost segregation study all over again. You accelerate the deductions into year one to create immediate tax-free cash flow, and you indefinitely defer the tax bill. You accelerate the gains and you defer the pains. That is how you build an empire. Your challenge today. This one is tactical. You need to build your team before you need them. Your challenge is to go to Google and search for cost segregation engineering firm in your state. Find 2 engineering-based firms. Not just tax accountants, engineering firms. Look at their websites. Do they list their credentials? Do they have case studies? Read one case study. Save their websites in a My Team folder. When you find your next 1 million plus deal, you'll know exactly who to call to run the numbers. I'm Martin Maxwell. We've just given you the why and the how of one of the most powerful strategies in the Pro Investors Toolkit. Use it wisely. Keep learning, stay strategic, and keep building.